A bear call spread is a neutral to bearish options trading strategy. It involves selling a call option and buying another call option with the same expiration date but at a higher strike price. This strategy profits when the underlying asset's price stays below the short call strike price. It is a limited profit, limited loss strategy, making it appealing to traders seeking controlled risk. Traders often employ bear call spreads when they anticipate a moderate decline in the underlying asset's price. The strategy benefits from time decay, also known as theta, and declining implied volatility. It is important to note that potential losses are capped at the net premium received when establishing the spread. The VIX, or Volatility Index, is a real-time market index representing the market's expectation of 30-day volatility for the S&P 500 index. Often referred to as the fear gauge, the VIX reflects the market sentiment regarding potential market fluctuations. A higher VIX value suggests heightened fear and anticipation of larger price swings. Conversely, a lower VIX value typically indicates calmer market sentiment and expectations of smaller price movements. Bear call spreads tend to perform well in environments with high implied volatility. This is because higher volatility generally leads to higher option premiums, especially for options closer to the money. When entering a bear call spread, traders aim to sell options when premiums are inflated due to high volatility. As volatility contracts, option premiums tend to decline, benefiting the spread. Section 4. The Greeks and their influence on bear call spreads. The Greeks are risk measures that quantify the sensitivity of an option's price to various factors. Delta measures the change in an option's price for every $1 change in the underlying asset's price. A bear call spread has a negative delta, meaning its value increases as the underlying price declines. Gamma measures the rate of change of delta. A bear call spread has a positive gamma, meaning its delta becomes more negative as the underlying price decreases, accelerating profits. Theta represents the time decay of an option's value. A bear call spread benefits from positive theta, meaning its value increases as time passes, assuming other factors remain constant. Vega measures the sensitivity of an option's price to changes in implied volatility. A bear call spread has a negative vega, meaning its value increases as implied volatility decreases. Section 5. Applying the bear call spread. An example from the Indian market. Let's consider a hypothetical example involving the Nifty 50 index in the Indian market. Scenario. The Nifty 50 is currently trading at 19,500. Outlook. You have a neutral to bearish outlook on the Nifty 50 over the next month. Strategy. You decide to sell a Nifty 50 call option with a strike price of 19,600 and buy a Nifty 50 call option with a strike price of 19,700, both expiring in 1 month. Outcome. If the Nifty 50 stays below 19,600 by expiration, both options expire worthless, and you keep the net premium received. If the Nifty 50 declines, your profit increases. The maximum loss is limited to the net premium paid if the Nifty 50 surges above 19,700.